So the good news is that something did break to at least get the Fed to think about what it's doing. The bad news is, 2 days after Silicon Valley Bank went under, along with Signature Bank, the Fed raised interest rates 25 basis points. The Fed has never before this time raised interest rates in the middle of a crisis. And here again, they're talking about another 25 basis points in early May. With today, I think it was Christopher Waller coming out. He's at the St. Louis Fed and talking about inflation just being way, way, way too high. And so I'm going to go through, as usual, fiscal policy, monetary policy, economic indicators, market signals, which the Fed does not seem to respect, but we think that it will follow these signals ultimately, and then a little bit about innovation.
Most of the cryptocurrencies were trading higher on Friday amid better-than-expected U.S. economic data. Bitcoin rose 0.67% to $30,500, whereas Ethereum was above the $2,100 level. BTC volume stood at approximately $18.62 billion, rising 6.42% in the last 24 hours. Hello and welcome to Money Talks. In today's video, Cathie Wood, CEO of ARK Investment Management, updates us about the current market cap of the crypto industry and reaffirms her firm belief in disruptive innovation.
I think the most remarkable of all the indicators that we monitor was Bitcoin during the crisis. Now, it typically acts like a risk-off. It tends to do poorly during risk-off periods. This time it did the opposite. From March 10th, when it bottomed at 19,500, it has soared 55% to $30,270. Ether has gone up 51% from 1,370 to 2,076. So these previously volatile, risk-on metrics are acting like flight to safety. Well, we think this is a theme that you should be watching out for. We think a lot of innovations out there are going to be the flight to safety. Why? Because they're going to disrupt the traditional world order. What are Bitcoin and Ether doing? They are, by the very fact that they're being considered flight to safety like gold, that's really interesting and suggests much broader-based adoption and acceptance than I think most people understand. And given the government's railing against crypto and really putting pressure in all kinds of regulatory ways on it, we do believe this is going to become an election issue. M2 growth on a year-over-year basis peaked at 27% in early February of 2021. Now, remember, when COVID started, the fear was that the global economy was going to shut down and go into a depression. And so fiscal and monetary policy makers around the world moved into action, and 27% money growth in the United States was one outcome. But the money growth rate started falling pretty rapidly. And over the last 2 years, it's dropped 30 percentage points. We're now down roughly 3%. That's negative on a year-over-year basis. We have never seen a 30 percentage point decline in the growth rate of M2 on a year-over-year basis, ever. And And we have also not seen negative year-over-year M2 growth since the 1930s. So that was the time of the Great Depression. So we're taking this seriously. And we have been taking it seriously, as I think you will recall, for the last year. To listen to the CEO of Citibank say that, wow, who could have seen this coming? And the FDIC and the Fed acted with such alacrity. She was full of praise. But actually, you could see this coming. And we've been talking about it for a year. Credit default swaps started moving up. So those are bets on bankruptcy, or their insurance policies against bankruptcy. And they started moving up last spring as the Fed started to raise interest rates. And they started moving up on banks, all banks, including the money center banks, to the point where last October, I was saying, what is going on? JP Morgan's credit default swaps are getting close to where they were in the middle of the COVID crisis. So the credit default swap market was saying something's wrong out there.
Bankrupt crypto exchange FTX has recovered over $7.3 billion in cash and liquid crypto assets, an increase of more than $800 million since January, the company's attorney said on Wednesday at a U.S. bankruptcy court hearing in Delaware. FTX attorney Andy Dederich said the company is starting to think about its future after months of effort devoted to collecting resources and figuring out what went wrong under the leadership of indicted ex-founder Sam Bankman-Fried. Bankman-Fried has pleaded not guilty. The situation has stabilized and the dumpster fire is out.
So what might explain this? Well, it could be that the market, paying attention in all its wisdom, even if the Fed wasn't, the market was paying attention. We were in a bear market last year, and the market was saying something's going to break here. And now we know what it is. Is there a buy on the news, or a buy now that we're near the end of this? As I just mentioned, I'm not sure we're near the end of it. I don't know why deposits are going to flow back into the banking system, given current dynamics. But if we are about to experience, some people would say soft landing. I find it hard to believe this will be soft, but soft or hard landing, what that will mean is inflation and interest rates are going to continue coming down, and the Fed will follow them finally. The markets always lead the Fed. So that could be what's going on here. If you remember what happened, our strategies, innovation-based strategies, they started underperforming in February of 21 when the whiff of inflation and interest rates going up with supply chain issues started. And the market just started discounting, saying, interest rates are going to go up at some point. This category of stocks is not going to do well. Well, we could be on the flip side of that, because it does seem like innovation-based strategies have done very well. Now, the yield curve is telling us that we're not out of the woods yet either. It did drop to more than 100 basis points of inversion on March 8th, and the crisis took care of that. But we're still inverted at 58 basis points today. So now many people looked at the 100 basis points and they said, oh, well, the last time we were here was in the early 80s. We got inflation under control with 100 basis points inversion back then. And that's true. But I think the analysis is a bit off. It basically underestimates how powerful Fed restraint is today, because 100 basis points or 1% against a 15% long bond yield is a lot different from 1% against a 4% bond yield. So 1 over 15 is 6.5. Use the Richter scale here. 6.5 on the Richter scale is a pretty powerful earthquake. I've been in a couple of those, and they are not pleasant. They're actually quite eerie. 1 over 4 would be 25 on the Richter scale. We've never seen an earthquake of that magnitude. In fact, I think the highest has been 10. So I think if we look at it from that point of view, that the Fed has been making a mistake, and we are going to see more ramifications of this.
So what are your thoughts about Cathie Wood's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.